Stop what you're doing. Seriously, if you have a single dollar invested in the stock market right now, you need to hear this. We are living through one of the most shocking, mind-bending economic disconnects in modern history. Wall Street is basically planning a massive victory parade, pricing in this unprecedented golden age, while Main Street is quietly running out of gas. Last week, I dug deep into the latest data across global markets, retail, and energy, and what I found completely shocked me. Today, we're unpacking the 2026 macroeconomic paradox, and by the end of this explainer, you're going to know exactly whether this massive tech-driven market rally is actually going to pay off, or if it's a giant trap just waiting to spring. Okay, let's dive into this. 8,000. That is the absolutely jaw-dropping year-end projection for the S&P 500 that was recently published by Goldman Sachs. I mean, it's a target that would have seemed borderline insane just a short while ago, right? The markets are on a rocket ship, and investor optimism is just downright euphoric. But you have to ask yourself, what exactly is fueling this massive surge? Well, take a look at the staggering projection right here. 24% annual growth in earnings per share for 2026. 24%. But here's the catch, and it's a big one. This explosive rally is built almost entirely on the shoulders of artificial intelligence. Roughly half of all that projected growth comes strictly from the companies laying down the actual infrastructure for AI. Wall Street is completely captivated by this futuristic promise. It's a full-blown digital gold rush. Which brings us to arguably the boldest question of the year. We see the tech bets, right? We see the stock market breaking records left and right. But is the real economy actually keeping up? Are everyday consumers and traditional industries feeling anything even close to a 24% boom? Here's exactly how we're going to untangle this. First, the 2026 market paradox. Second, sluggish global economic growth. Third, consumers feel the squeeze. Fourth, pushing for industry efficiency. Fifth, the clean energy tipping point. And finally, navigating the 2026 economy. Let's get into it. Section 1, the 2026 market paradox. We really have to start by stepping back to view the broader macroeconomic landscape. And this brilliantly illustrates the intense friction going on right now. The divide is literally glaring. On one side, you have pure, unadulterated market optimism, the bull market hitting unprecedented highs, riding that 24% AI earnings growth. But then you look at the physical side, and the economic reality is heavy. It's stubborn. According to the Bureau of Labor Statistics, the Consumer Price Index, inflation, basically, remains sticky at 3.8%, and the job market is definitely softening. So it's booming exuberance on Wall Street clashing against persistent, grinding costs on Main Street. Section 2, sluggish global economic growth. Now, we have to ask, is this just an American thing, or is the rest of the world feeling this exact same lag? Let's look at the latest World Bank data. Notice these regional GDP projections across the board. The World Bank is projecting East Asia's growth to slow down to 4.4%, which is heavily constrained by structural bottlenecks. Europe is holding steady, sure, but at a very low 2.4%. And Latin America? Edging up to a mere 2.3%. So the reality is, there's absolutely no 24% boom happening in the physical production of global goods. Output is being tightly held back by geopolitical uncertainties and really high trade tensions. Section 3. Consumers feel the squeeze. Let's zoom in from that macro 30,000-foot view and see how this actually translates to everyday wallets. Because at the end of the day, an economy is driven by people buying things, right? According to Bain & Company's 2026 Global Retail Sales Outlook, consumer spending is decidedly muted. Look at these top global markets. We're forecasting a really modest 3.5% growth in the US. Germany is sitting at 2.5%, and the UK is barely moving at 2.0%. And here's the kicker. When you adjust these numbers for the sticky inflation we just talked about, actual volume growth, like the physical amount of stuff people are actually taking home, is basically flat. In some cases, it's actually shrinking. So why are consumers pulling back so hard? Bain breaks down exactly what's straining shoppers. Inflation on daily essentials isn't budging, unemployment is ticking up slightly, and consumer confidence is just incredibly fragile right now. As a result, we're seeing this massive flight to value. Shoppers are aggressively trading down, they're hunting for discounts, and they're completely abandoning premium goods. There is a clear, undeniable disconnect here between the super cautious shopper in the grocery aisle and the exuberant trader on Wall Street. Section 4. Pushing for industry efficiency. So if global growth is sluggish and consumers just aren't buying more, How on earth are companies supposed to hit those sky-high market expectations?
Well, we have to go into the operational trenches to find out. And the crucial point is this. Industries are missing their top-line growth targets, and they are facing massive operational costs. Take the software as a service industry, for example. This was the darling of endless growth, right? They planned to grow 35%, but only hit 26%. Meanwhile, over in pharmaceuticals, the cost of research and development to bring just a single drug to market has skyrocketed to an average of $2.23 billion. I mean, with revenues squeezed like this, companies are being forced to find massive internal efficiencies just to keep their heads above water.
And this brings us to a really fascinating metric. It's called OEE, or Overall Equipment Effectiveness. Think of it as the ultimate gold standard for measuring manufacturing efficiency. Essentially, it asks, how well are your machines and production lines actually running compared to their true maximum potential? According to Intuition Labs, the pharmaceutical industry, despite making these incredibly high-tech, life-saving drugs, currently lags behind almost everyone else, with a median OEE of just 23%. That is wild. It means the vast majority of their manufacturing capacity is just lost. It's eaten up by downtime, slow batch releases, and mechanical hiccups. But here is where the puzzle pieces finally fit together, and it connects right back to that AI story we started with. Integrating AI and digital tools, a movement they're calling Pharma 4.0, can nearly triple this efficiency. Digitally enabled sites are pushing their OEE from that dismal 23% up to 60% or even higher. They're using real-time data to cut batch release times from 25 days down to just 15 days. This right here is where Wall Street's AI dreams meet Main Street's operational reality. The only way these companies can actually justify their current valuations is by using these new technologies to drastically lower costs and unlock all that massive hidden capacity. Section 5, the clean energy tipping point. Alongside this massive digital push for efficiency, there's another huge positive structural shift happening that is actively rewiring our physical economy. Now, what's really interesting about this slide is the data from Ember's Global Electricity Review. It shows the shifts in global electricity generation coming in 2025. And guys, we have hit a massive milestone. For the very first time, clean power generation successfully met all of the new growth in global electricity demand. The world needed more power, and renewables completely stepped up to the plate to provide virtually all of it. Which brings us to this absolutely staggering number. 10,730 terawatt hours. In a historic first, global renewable energy generation officially surpassed global coal generation. Think about that for a second. While the financial markets were completely obsessed with software and AI, the physical world was quietly achieving a monumental clean energy tipping point. Just look at the scale of these solar installations. This isn't just a spreadsheet or theoretical modeling. This is rapid, real-world scaling of clean power infrastructure, and it's happening all across the globe. Cheap, daytime solar power is fundamentally transforming how our power systems operate, from China to Brazil to the US. In fact, solar generation grew by a shocking 29.7% in just one single year. That unprecedented surge single-handedly prevented what would have been a guaranteed rise in global fossil fuel emissions. It proves that even while the broader consumer economy might be sluggish, targeted sectors of our physical infrastructure are rapidly rewiring to support the future of the global economy. Section 6. Navigating the 2026 economy. So, how do we synthesize all these totally conflicting signals? Let's bring all these threads back together, because it all perfectly aligns with this profound quote from the Goldman Sachs report. They said, generating sufficient returns on AI investment spending will ultimately require that enterprise end users enjoy sufficient productivity gains. In other words, Wall Street's dream of an 8,000-point S&P 500 completely 100% depends on fixing Main Street's sluggish productivity. The tech companies building AI are only going to remain valuable if everyday retail chains, pharmaceutical manufacturers, and energy grids actually use that tech to become cheaper, faster, and way more efficient. Which leaves us with this final thought. The stock market has pushed all its chips into the center of the table on a technological revolution. But with consumers totally tapped out and global growth slowing down, the pressure is entirely on physical industries to execute. Will the market's massive tech bets finally translate into real-world efficiency and pay off for everyone? Keep a very close eye on those efficiency metrics, because that right there is where the true economy of 2026 will be decided. Thanks for joining me on this explainer, and I'll see you next time.